everyone. Thank you for joining us for today's webcast, Gold and Silver, Precious Metals on the Move, sponsored by Sprott. Today's webcast will provide one CFP, IWI, and CFA CE credit. If you have questions on credit, please give us a call via the number on the console. We welcome and encourage your questions. You can type your questions in the Q&A box, and we'll do our best to get to as many of your questions as possible. Materials, including today's presentation, have been made available for download from the Documents folder at the bottom of your screen. We appreciate your feedback. Please take a moment to take our brief survey that's also located at the bottom of the console. We will cover quite a bit of information during today's webcast. If at any point in time you're interested in scheduling a one-on-one meeting with Sprott, please click the blue Confirm button in the media request box on your screen. Lastly, in the event you missed any part of today's webcast or simply would like to watch it again, a replay will be made available, and all registrants will receive that information by email. With that, I'm pleased to introduce our first speaker today, Edward Coyne, Senior Managing Partner of Global Sales at Sprott. I will now turn the webcast over to Ed to get started. Welcome, Ed. The floor is yours.
Great. Thank you, Sarah, and thank you all for joining our webcast today. I've asked two featured speakers to join us today, John Hathaway and Maria Smirnova. And again, my name's Ed Coyne. I'm the Senior Managing Partner and Head of Global Sales of Sprott Asset Management, and going to be walking you through the webcast today. John Hathaway is a Managing Partner and Senior Portfolio Manager at Sprott Asset Management. John joined Sprott in January of 2020 and is a Senior Portfolio Manager of the Sprott Special Situation Strategy and the co-portfolio manager of the Sprott Gold Equity Fund. Previously, John was with Tocqueville Asset Management LP, where he was a co-portfolio manager of the Tocqueville Gold Fund. John began his career in 1970 as an equity analyst at Spencer Trask and Company and earned his BA from Harvard College and his MBA from the University of Virginia. John also holds a CFA designation. Also with us today is Maria Smirnova. Maria is a Managing Partner, Senior Portfolio Manager, and Chief Investment Officer at Sprott Asset Management. Maria has over 24 years of investment experience and joined Sprott in 2005 as a research associate supporting the metals and mining team. Currently, Maria serves as a lead portfolio manager of the Sprott Sub-Advised Silver Equities Fund and co-portfolio manager of the Sprott Sub-Advised Gold and Precious Minerals Fund. Maria also serves as a portfolio manager on the investment team for the Sprott Gold Equity Fund. And prior to joining Sprott, Maria served as a product development analyst at Fidelity Investments and holds a Master of Business and a Bachelor of Commerce from the University of Toronto, and also has the CFA designation. For today's webcast, I've asked John Hathaway to talk about gold's performance and its outlook. And then we'll turn to Maria Smirnova to talk about silver's performance and its outlook. And then before we open up the webcast to Q&A, I'll touch briefly on the ways to allocate both gold and silver into your portfolio. For our listeners on today's webcast that aren't familiar with Sprott, Sprott is a global leader in precious metals and critical materials investments. With over $29.4 billion in assets under management as of the end of the first quarter, March 31st, Sprott has a full suite of solutions in both exchange-listed products, managed equities, and private strategies. Sprott is a publicly listed company and trades on both the New York Stock Exchange and the Toronto Stock Exchange under the ticker symbol SII. At Sprott, for investors who want to own physical metals, we offer a suite of physical bullion trust, physical uranium trust, Sprott Energy Transition ETFs, and gold mining equity ETFs. In addition, we have a suite of managed equities with close to $3 billion in assets, which is made up of our flagship mutual fund, the Sprott Gold Equity Fund, a closed-end value fund, an energy transition critical minerals fund, and a Sprott Hathaway special situation strategy. And last but not least, we have a suite of private strategies which focus on bespoke credit investments to mining and resource companies. Now with that, I would like to turn it over to John Hathaway to talk about gold's performance and its most recent outlook. John?
Thanks, Ed, and good morning or good afternoon to everybody who's listening in. Gold has broken out decisively from a 3-year consolidation. Um, it just happened recently. It happened this year. It's been trading back and forth for what seems like an endless period of time. But now I think the message is clear that the metal is headed higher. And we'll look at a couple of the charts and talk about that, what possible upside still remains. I know it's easy to think, well, I've missed the move, but I think we are still in really very early days. And I think the particular opportunity, the most exciting opportunity, is in gold mining equities. Even today, they lag behind what the gold price has done, or they're basically neck and neck with the gold price, which is uncharacteristic. Typically, they outperform in a bull phase what the metal is doing. And I'll talk a little bit about the reasons why that is. And I think the point I want to make here is that the leverage to higher gold prices in the gold equities is very substantial. And the fact that they haven't moved yet, I think, is why the opportunity here and now is quite compelling to make investments in the mining equity space. And lastly, on this first slide, I want to bring up the point that gold has had this powerful move and a breakout and headed higher, in my opinion, despite the fact that there's no interest or very little interest from investors in our part of the world. What's taking place here is really because of factors overseas. There's some macro factors that I'll talk about. But basically, I would say in Western capital markets, investors are basically asleep at the switch. And there are reasons for that. I think probably many people are very comfortable with their existing portfolio allocations in mainstream equity allocations, and maybe even in bond, in fixed income. But I do think that can change. And I think when investors in our part of the world start to get interested in gold and gold mining equities, we could see gold trade well above where it is today. Right now, it's trading roughly around $23.50 an ounce. I think once our part of the world gets on board, we could see gold trading in a range of $2,500 to $3,000 over the next year and a half or so. So let's go to the next slide, please. So here's what I was talking about. The slide basically shows that a range going back to 2020, summer of 2020, and really just the beginning of this year, gold was locked in a range of roughly 2060 to, on the upside, to probably just a little above 1600 on the downside. So it's been doing a lot of churning, a lot of work for the last 3 years. And then at the beginning of this year, it has broken out decisively. Technicians, and I'm not a technician, but I listen to what they have to say, would tell you that this pattern should resolve itself in a move close to 2,500. And that's probably, I'm editorializing, probably conservative. But I think study this chart and draw your own conclusions. But the breakout is decisive. It's not going back below 2,000 and probably headed higher. So let's go to the next slide. This is one of the best kept secrets in the Western world. Gold has outperformed everything, stocks, including dividends, bonds, and of course the US dollar, since 2000. I don't think most people would know that if you just asked them randomly, but it's a fact. And why do we use 2000 as the starting point? The reason is that is the beginning of radical monetary policies. Greenspan, followed by Bernanke, and now we have Powell. The cat is out of the, I'm trying to think of the right analogy, the toothpaste is out of the tube. We're on a treadmill of money printing and debasement of the currency. And gold has figured this out, and there are a lot of reasons for it. And if I have time, I just don't want to cut into Maria's time too much. I will suggest a couple of the factors that are behind this. Let's just go to the next slide. This again is to the point. This is, to me, a terrific slide. The positioning of investment advisors is the lowest since 2019. And you can, at your leisure, come back and look at it. But that tells you that nobody's aboard. And if the pendulum swings more in the direction of investors wanting to take a positive view of gold and gold mining stocks, there is plenty of buying power that's waiting in the wings. And I guess this is another way of saying that we are at the very early stages of a powerful bull market in gold and gold mining stocks. Let's go to the next slide. And here's something that drives me crazy, but this is from Bloomberg, and it is the consensus forecast of major banks, and the major banks would include J.P. Morgan, Morgan Stanley, Merrill Lynch, all the establishment thinking, and the forecast is for gold to decline between today's levels by, let's call it 10, 15%. I don't know what they're thinking with the way the world is changing. But I think this is a reason for the lack of interest, and it's, your favorite economic forecaster being clueless to what's going on in the gold space. I guess I don't want to beat that horse too much, but this is why I think this is one of the major reasons why investment interest in what we at Sprott are doing is still, I said, asleep at the switch, has missed the train. The train is moving. So enough on that. Basically, consensus expectations for gold are totally out of whack with reality. Let's go on. And this again is to the point of lack of investment. So the gold price has done what it's done. Tremendous move higher with more to come. And at the same time, investors in gold-backed ETFs, GLD would be the principal one, have actually been selling. So assets are declining in GLD. But if you go back to the formation of GLD back in 2004, you can see that there was tremendous asset accumulation by people in our part of the world. And that was instrumental in driving the gold price substantially higher through those middle and late years of the first decade of this century. That hasn't happened yet. But again, when folks in our part of the world wake up to what's going on, that's how I get to my arm wave of gold trading between 2,500 and 3,000. Okay, enough on that. Let's go to the next chart. So here, this to me is a big deal. And this, what I want to say here is that the shelf space of the US dollar as a reserve asset has been in a steady decline, and it's at the lowest level it's been over the last 20, well, I would say last 20 years. So there are a lot of things to say about this. The first thing I would say is that trade is being done increasingly away from the US dollar. You'll see on the next slide, I believe, that central banks have been buying record amounts. And why is that? There are a lot of reasons for it, but essentially, geopolitics is playing a role. I think that the fact that the U.S. has weaponized the U.S. dollar. Here's the central bank slide, but let's go back to the other one. Weaponizing the U.S. dollar, and I think that was a big factor in why gold has started to take off and started especially to outperform against bonds. I think bonds are a big factor. I don't have a slide on that, but gold has broken out against TLT, 20-year Treasury, ETF, and also against TIPS. That started about the same time when the U.S. started to weaponize the dollar and particularly for adversary countries, Russia, and I think it started with obviously the war in Ukraine and what we did with freezing Russian reserve assets that held in the U.S. So there are fewer dollars settling trades, and they're being settled in local currencies, whether it's RMB or Indian rupees, Brazilian reals. And when there are surpluses, they are being recycled into gold. That's why central banks have been buying. And they're not being cycled into U.S. treasuries in this sort of style of the petrodollar, which was a big factor going back to the mid-1970s. So here we have less and less pools of capital available or willing to recycle trade surpluses into US dollars at a time when Treasury issuance is off the charts. Budget deficits running at $2 trillion in a full employment economy. And what happens in a recession? So we haven't seen the rubber meet the road here, but when you have Treasury issuance going up and the pool of capital available to absorb that going down, it's only a matter of time before the Fed starts back on a path of quantitative easing and much easier monetary policies. In fact, I would even make the statement that the Fed, which you see so much obsession about on Bloomberg and CNBC and whatever channel you tune into, is less and less relevant than it's ever been. And the things that are relevant are what I've talked about: central bank buying of gold and the lack of willingness of foreigners to hold or recycle trade surpluses into U.S. treasuries. Let's go to the next slide, which we just looked at. Record buying of central banks of gold, which has basically been a big factor underpinning the gold price where it is today. And then if we go to the next chart, which is really what I'd like to focus on and maybe have as the takeaway for what I'm talking about. The opportunity, of course, is in owning the metal itself. It's become the premier safe asset, displacing bonds, in my opinion. I think the message is slowly and surely getting out. I'm not saying that there isn't a trade in bonds if we have a recession, but on a longer term basis, I would say that gold has emerged as the premier safe asset. And then gold stocks, which are joined at the hip with gold because their margins are mostly affected by what the gold price is doing. There are a lot of other factors that we as a team look at on a daily basis, but the gold price is the single most important determinant of earnings and cash flow for gold mining companies. And you can see here that gold stocks have lagged for the last what is it, 10 years, at a time when the gold price has done really well and gold stocks seem to be stuck in neutral. They're starting to wake up, but I guess the thing I'd like to leave you with is that for those portfolios where a more aggressive stance is appropriate in terms of positioning for a longer term scenario of monetary debasement, then gold stocks, I think, are where you want to have at least some allocation. And I would say, based on flows into the Van Eck GDX, which is the proxy for the level of interest in gold mining equities, there have been no inflows. In fact, I'd say on balance year to date, they've been either flat or neutral, despite the fact that gold stocks are up probably about 14% year to date. Our Sprott Gold Fund is up about that, or a little bit more. But there's a lot more to come, and especially so if the gold price continues to move higher, as the technicians think it will, and that should be very good for earnings and cash flow of gold mining stocks. I would just mention in closing that the market cap of the entire gold mining space is about the same as Home Depot or MasterCard. So it will not take a lot of money moving in when it decides to move in to create outsized moves, percentage moves and gains, again, with the backdrop of improving fundamentals in gold mining equities. So I guess you could take this as me pounding the table on this is the time to get aboard, to build positions in not only gold, but also in gold mining equities. And with that, I will complete my remarks and turn it back over to Ed to introduce Maria.
Thank you, John. And John, before we go to Maria, in your view, because you've been doing this for, multiple decades now, why is it you think that investors aren't paying attention? A, they're leaving physical, and B, they're not even thinking about gold equities. Over the last couple of decades of investing, have you seen a time like this in the past? I mean, that last chart, I think, is very telling that investors really aren't paying attention right now. What do you think is going to change that?
Well, that disconnect I've never seen. And as you mentioned, I've been doing this for 25 years now. I've never seen it. I attribute it to the strong stock market. And I would also say I would attribute it to the consensus expectation of a soft landing. We don't have time to get into a debate on that. But I would say if either the stock market falters or the economy falters, and again, I have a lot of thoughts here, but I just don't want to get into Maria's time. I think those are the props for consensus thinking. And that, I think, I would attribute those two factors to the level of disinterest in gold mining and gold mining stocks. So if either of those things change, I think people will look for other things to do. And I think one of the things they'll find very appealing will be what I've just talked about.
Great. Thank you for the clarification on that. That's very helpful. I'd like to now turn it over to Maria to talk a bit about what's going on in the silver market, talk about silver's performance, and Maria, give us an outlook on what you're seeing in silver in general. Maria?
Thanks, Ed, and thanks everyone again for joining us today. I think I will echo a lot of what John said about gold, as a lot of these factors also apply to silver. Now, silver, of course, is an interesting metal. I always call it a metal of two heads, being the investment side and the industrial side. But overall, I would say the similarities with gold are that silver is breaking out, or we think it's broken out. Equities, well, the metal itself is underfollowed, and in the West, it's underinvested. But also the equities, specifically silver equities, are very underfollowed, and underowned and very cheap. And I'll have slides on all of this coming up. And of course, silver equities exhibit tremendous leverage to the silver bullion. And similarly to gold, sell-side analysts by far and large have silver prices declining into the future. So the chart that John showed with gold price projections, similar things can be said about silver prices. And of course, that affects how we value the equities and the value we place on the equities. But I would also argue silver is infinitely harder to find in terms of, silver is not that hard to find in the Earth's crust, but to find economic deposits of silver is very hard and getting harder. And to develop these deposits has been harder. And again, I'll show a slide of what's happening with mine supply over the last few years. So here we are. This is a graph of the silver price. It's currently trading at around actually $28.50, so about $1 higher than this chart shows. Something that people always ask me about is the gold to silver ratio. It's currently at about 83-1. In fact, it's moved rapidly from 90-1 in the beginning of this year to now 83-1. And as a reminder for people, silver does, can move quite quickly and rapidly. The gold to silver ratio peaked actually at 120 back in COVID times. And since then, obviously, it's gone to 83-1, but averaged about 59-1 since the 70s. I won't belabor this point, but that's kind of the magnitude of the moves, relatively speaking, that we can see. So let's turn the slide. This is, again, a chart similar to what John showed, and this is the flows of silver ounces into and out of ETFs. As you can see, the blue line has been declining since about 2021. We have seen outflows of silver out of the ETFs, and a similar thing has happened at the end of 2022, where the silver price actually disconnected from these flows, even though up until then, it was correlating pretty strongly with the flows. Well, number one, what it's showing is that the demand for silver bullion in the West has been quite weak, again, outflows. But the price of silver has disconnected. And we think it's primarily because of demand out of the East, being China and India being the big consumers of silver. Now, unlike gold, central banks do not buy silver. So there are other variables at stake here. So let's turn the slide. This slide, I'm not going to talk about India. I can mention India because they have been big importers of silver recently. And of course, it's a big investment vehicle for individuals in India. But what we're seeing in China also, there's a lot of trading activity, and that's picked up again somewhere at the end of 2022. So it really correlates with that disconnect with the ETFs. You can see on the chart on the right, silver activity on the Shanghai Trading Exchange has really picked up since then. And also, it's important to note that the Chinese people are paying a premium over spot on silver, and it's reached as high as $4 an ounce. And that's it's a change in magnitude. $3 to $4 is a pretty high premium to pay just to have the metal delivered to China. And again, that means that, this metal it's a physical trade. China and India want the physical metal. They're not content with just having paper metal. And that's a very important factor, because especially for silver, because silver is used in many different ways, especially in industry, but in small amounts. A lot of these uses, you don't recover the silver back. So the fact that the physical ounces are going, likely we're never going to see them again. And I would like to take a closer look. This is going to be a very busy chart, unfortunately, but I wanted to talk about this silver supply and demand and what's happening with the different variables here. Let's start at the top, and let's start with supply. And this is, by the way, history over the last 10 years, as you can see, going back to 2014. What I focus on at the top is the top line. Look at mine production. We have actually lost about 50 million ounces from 2014 to last year. 50 million ounces, that's 5% of the market we lost just in mining. So the mining industry never was able to recover after COVID, after that drop in production in COVID. Recycling also it's been up 20 million ounces, but that's not offsetting the decline in production. So overall supply has declined about 50 million ounces from 2014. So that's big. That's a big number because, again, as I mentioned earlier, silver is hard to find. To find an economic deposit, even though silver comes with usually lead zinc or copper or gold, it's getting harder and harder to find an economic deposit. Grades are coming down. Political geopolitics are playing a role because many countries are becoming more difficult to work in. And so that's affecting the mining industry. Now, on the demand side, we've actually gained about 174 million ounces from 2014 to last year. Huge amount. Again, the market is about, as you can see here, 1 billion ounces of supply. So to gain an incremental 170 million ounces, that is huge. And of course, most of that growth has happened in industry. You can see the top line of the demand side. That's where we've seen the most gains. And a lot of these gains have come in the electronics sector. If you think about anything we hold in our hands, any electronics we have, such as phones, computers, our cars, these things have silver in them. Again, in small quantities, but multiply that by billions of units and it adds up. And of course, a big part also, the big driver recently has been photovoltaics. All of this is part, of course, of a green drive, I would say, of countries around the world wanting cleaner air and trying to transition away from fossil fuels. So all these numbers, of course, it makes silver a great green metal. And, not everyone is realizing that yet, but I'm reading more and more people are catching on. So in terms of the photovoltaics, let's focus on that for a little bit. You'll notice that from 2022 to 2023, the photovoltaics grew by a whopping 70 million ounces. Huge growth. Why is that happening? Well, solar panel installations grew rapidly last year. Some estimates say 80% last year alone. A lot of it was driven by China. And of course, it's also driven by these incentives, governments providing subsidies and incentivizing both individuals and corporations to install cleaner energy. And solar is a great benefit. And, a lot has been said about thrifting in solar. We can go to the next slide. A lot has been said about thrifting in solar, but I think we're reaching a point where thrifting is becoming more and more limited. And what we're reading more and more about recently is an emergence of newer technologies. And this is the chart on the right, the very right chart, and the middle chart. The newer technologies actually use more silver per watt of energy. So the older technology is called PERC, and it uses 15 milligrams per watt of energy. Whereas the newer types of panels, TOPCon and HJT, use on average 50 to 150% more silver. So the loadings of these new panels is actually going up. And guess what? The middle chart is showing that the penetration or the acceptability of the newer technology is increasing. So all of this means that will hopefully offset the thrifting that has been going on, and combined the increased installation capacity every year, that will only lead to more and more silver being consumed.
Hey, Maria, before you go to the next page, could you address solar panels as we've gone into the second and third decade of these now being used and consumed at a much higher level, more public level? Can you talk a little about the recycling? You get a lot of misinformation out there of silver panels. The solar panels are recyclable, they're not recyclable. Could you talk about that a bit and what that looks like from the supply-demand standpoint as well?
Yes. So I have read conflicting reports about recycling. Well, first of all, solar panels last quite a long time. I think they last 20 to 30 years at least. So the cycle is long. But also in terms of recycling, I've not read about a widespread recycling program. It's very hard to extract silver from the silica of the panels. Similarly to other, it's easy to recycle a fork or a knife or silverware, but it's much harder to extract these tiny little amounts out of telephones and TVs, and it's very expensive. So again, that goes back to that slide that I had. Scrap supply or recycling, that line has not been growing. It has not been growing for at least the last 4 years, I would say. So I think recycling is limited. There's limited things you can recycle. And I don't think, I'm not anticipating, and at least I've not read about a wave of this silver coming out of the solar panels.
Thank you. So to your point, silver gets consumed and it doesn't re-enter the market in many cases.
Right. Unless it's, it's in a form of a coin or a bar, something chunky like that. Yeah.
Mm-hmm. Thank you.
All right. So just to finish on recycling, again, I don't want to belabor it. I just think it is, as many people are aware, it is the most exciting kind of area of the market. Going to the next slide. Someone at Sprott, not myself, just to be clear, somebody with less invested in this, tried to make a projection using past data. By 2030, how much silver will we need just for photovoltaics? And the answer is, according to this projection, with a 16% average growth rate, it's about 370 million ounces. Again, putting that into perspective, I always go back, it's a 1 billion ounce supply market. So if we need an extra 150 million ounces, well, that is between 10 and 20 major silver mines, and by major silver mine, I define as 10 million ounces, that's a major silver mine. We're just not seeing the discoveries and new supply coming on to provide that metal. So what does that all mean? Well, these deficits that we're seeing will continue, and I think they will grow. And that just means one thing, that is going to be good for the silver price. And we can see explosive moves in the silver price. Let's touch upon something else now. I wanted to touch upon exchange inventories of silver. That's been a pushback on why does silver price not behave better? Well, the above ground inventories have been a pushback, and we can turn to the next slide. Here I show just the exchange traded inventories. And, and sometimes people tell me, well, we should look also at all other vaulted silver, or we should count ETFs. I don't necessarily agree with that, because I think I am looking for what's readily available. If there's a deficit and there's a shortage, what is readily available? Well, according to this chart, it's you can see this adds together LBMA, which is London, SHFE, which is Shanghai, and the COMEX exchanges. And as you can see, there's been a significant drop in the last couple of years. So since February of 2021, we have lost about 480 million ounces out of these exchanges alone. And that's very material. And that is a good trend to see, actually, because you can see that in the past, before 2021, inventories were actually growing. So this is a major step change, and now the inventories are headed in the right direction. Just taking this a little bit further and going to the next slide, a lot of the ounces in London or the LBMA are actually earmarked for ETFs. And in fact, about 500 million of the 800 million ounces are earmarked for ETFs. So that means there's only 300 something million ounces available as free float, quote unquote. Again, that's very important, because what we're trying to establish is, if there's a shortage, where's the metal coming from? What are the sources for the metal? And obviously, if we have this metal locked up in ETFs, that's not technically freely available metal. So that really gets me excited to think about the future of silver. You know, you take a stagnating mine supply, you add to that very healthy growth in demand, and then that translates to dwindling inventories. Well, that is exciting. This is why we're starting to see the price move. So let's talk about the equities now, and I'll finish there. Obviously, as I mentioned in the very beginning, and similarly to gold equities, silver equities have been beaten up. A couple of years ago, they reached levels really at trough levels. So here we have a simple chart, very simple chart. I'm not talking about cash flows or anything like that, just an enterprise value per ounce of metal in the ground. Only recently has that been perking up, as shown by the blue line. Well, the blue line is the producers and the gray line is actually the developers. So both have been at low valuations. But you see the developers, these guys have really suffered, and their valuations are really low. And that is one thing that I always say to my investors, this is something I focus on. I'm always looking for the next exploration story. I'm looking for the next discovery. Who will find the next mine? And again, only recently, starting with this outbreak in the silver price, have valuations started to recover. But as you can see here, we're not nearly at valuations of years past. And this is not going back far. Prior to 2020, back in the last run, these valuations were much, much higher as well. And I will say this, I think John touched upon, Fed pivot and how the economy is doing. Well, we know one thing, that silver equities consistently outperform both bullion and even gold equities immediately following a Fed pivot. So when the Fed signals that they're turning their posture from tightening to easing, that's when the equities start reacting. And we think we've had that kind of pivot in December. It's a pause for now, and the expectations of a Fed cut have been pushed out recently, I think. But we think it is happening. And again, this is a conversation for another day. But I will say this, back in January of 2001, during the tech crash, back in November of 2008, during GFC, January 2016, December 2018, March 2020, silver equities rocked. And I'm not talking 50%, 70%. I'm talking 200, 300%. These are the kinds of gains that we can see in these equities when there's a turn in policy and when the sentiment changes for the better. And I think, I've named a lot of reasons why we like silver and why we think it's going in the right direction. And sooner or later, the equities will start to reflect that, hopefully. We just need some interest coming back here to the equities, particularly in the West. And I'll leave it there.
Thank you, Maria. So we'll be opening up the webcast in a few moments to address the many questions that have come in. We're close to 60 questions now. And for those that we don't get to, we'll be responding to via email and or phone call from our sales and marketing team. Before we do that, I want to talk a little bit about a core or general allocation and talk a bit about how do gold and silver actually fit into an investor's portfolio. And to really answer that question, it really depends on a couple factors. And this is really not that different than other investments. Clearly you have to think about the investor's risk tolerance. And that equates to the physical market relative to the mining or equity market. what your overall objectives are, what kind of time horizon do you have, any income requirements that are needed, and just your general overall financial situation. But I guess in short, the simple answer is it really is based on how much risk or how much equity exposure you have in a portfolio. So if you've traditionally had a 60-40 portfolio of 60% equity stocks and 40% bonds, we would recommend about a 5 to 10% allocation, taking a little bit from each, both on the physical side and the equity side, to give you some exposure and help you diversify your portfolio. Conversely, if you're much more opportunistic and you have, say, an 80% allocation to equities, then we would suggest something in the double-digit realm of say, 15% in gold and gold equities. And we always say physical first. When you're thinking about metals in general, or precious metals in particular, in a portfolio, the physical side of the market, physical gold, physical silver, has really been the low-cost way to have a liquid hedge in your portfolio. And then the equities themselves are viewed and used traditionally as a more tactical. So think of the physical as more strategic, more evergreen in a portfolio as a diversifier, and think of the equities as more tactical in a portfolio. And as John Hathaway said earlier, a potential replacement or complement to both fixed income and, in some cases, particularly for international investors, and to cash. You think about it from a currency standpoint, gold and silver have offered wonderful diversification opportunities within a portfolio. So we would say that on the conservative side, 5%, and on the more opportunistic side of your portfolio, say up to 15% in gold, silver, physical and or equities, seems to be appropriate when we look at what's been the most effective way to allocate to this space. And it really comes down to low correlation. If you look at gold as an example, gold has had consistently over 2+ decades now a low correlation to virtually every asset out there, whether you're talking about U.S. equities, international equities, U.S. fixed income, cash, real estate, and even other commodities like oil. Gold, as an example, has had a low correlation. And at the end of the day, when you're looking to diversify a portfolio, you want things that have a low correlation, that perform at different times for different reasons. And the chart John Hathaway showed earlier about gold doing quite well over the last multiple decades and outperforming virtually everything really speaks to that as an asset that performs differently at different times. So for those on the call today that have interest in what we're doing from a firm standpoint, from a investment product standpoint, I encourage all of our financial advisors and brokers out there to reach out to our senior investment consultants on the financial advisor individual investor team. For those that are on the, and I'm seeing this on the Q&A side, on the home office front, I'd encourage you to reach out to our key account team. And I've even seen a couple institutions with some questions here coming in that I recognize the names. And for our institutional clients, I encourage you to reach out to Glenn Williams and his team. So for those that have more interest in what we do and how we do it and the product suite we offer, please reach out to us, learn more about how we can help advise you and guide you down this journey, down this path of allocating to both the physical market and the equity market. So with that, I'll pause for a moment and turn it over to Sarah before we open up the webcast for Q&A.
Great. Thanks, Ed. Yeah, so as a reminder, materials can be found in the documents folder at the bottom of your screen. We appreciate your feedback. Please take a moment to fill out our brief survey, also located at the bottom of the console. Our speakers will be taking advisor questions. Please type your question in the box under the slides window, and we'll get to as many questions as possible. In the event your question is not answered on today's webcast, a member of the Sprott team will reach out to you directly. If you'd like to have a conversation to further discuss the ideas that were covered during today's event, please click the blue confirm button in the media request box on your screen. With that, I will send it back to Ed for Q&A.
Great. Thank you, Sarah. And I think we've got about 10 minutes for Q&A. As I mentioned, if we don't get to your question, we'll be responding via email and or phone call from our team. The first question, I think, is a good one for John Hathaway, and it's, if the Fed doesn't lower the benchmark interest rates this year, how do you think that will impact gold and silver spot pricing in the short and medium term?
in a word, I don't think it matters. I think the Fed has become less and less relevant. They're really sort of sneaking back into QE. They've reduced the pace of balance sheet reduction. And in addition, the Treasury is now buying a substantial part of Treasury auctions. So I think you could almost say the Treasury and the Fed have merged. And frankly, I sort of disjointed in my answer, but I think by and large, the Fed doesn't matter anymore to the gold narrative. I think there's so many other things that come into place before what Jerome Powell says or doesn't do.
Thank you, John. And it's interesting, you see in both rising rates and lowering rates, gold has been doing quite well. So yeah, I think you're onto something there. The second question here, I think, is a good one for Maria, and that is, when looking at silver, I'm sorry, the questions are bouncing around here a little bit as they keep coming in. Here we go. If you assume no growth in solar production, how does that impact silver demand? Are there other things out there that are driving that demand?
That's actually an excellent question. Well, first of all, already the solar market has reached critical mass where it's about 20% of the market. So we're already in deficits, right? So the base case here is a supply-demand deficit. The other areas we can talk about are other areas, kind of electronics and also green energy transition based. So, this is something I did not discuss in detail today, but it's basically vehicles. EVs have a much higher silver loading than combustion engine vehicles. So, and I don't know the magnitude, it might be double actually. So just by the adoption of electric vehicles, we're increasing total silver consumption. That is one area. And of course, the big one could be that if we do have a change of sentiment, and this has happened very drastically in the past, the physical investment line of the supply-demand function will fly up. We can see increased investment demand. Again, we've seen increased investment demand in the East, but we're not seeing it right now in the West. And as I've pointed out, ETFs have been in outflow. So if that reverses, that would be a huge factor to contribute to the deficits.
Great, thank you. John, let's go back to you. This relates to gold miners, and I guess it's sort of a comment/question. And it says, gold miners have had this type of price run-up in the past. What makes their miners different this time versus the past when they did expensive takeovers and buybacks? Are you seeing different behavior from miners today?
Yes, I would say by and large, there is more financial discipline, and I think that's partly because of investor pressure. This is not true of each and every company, but and the other thing I would point out is that at these gold prices, many of these companies are self-financing. They do not need to issue stock to stay in business or to build projects. So I would say we're kind of in a sweet spot. I'm not saying that they will always be more intelligent about their financial decision making, but right now I would say we're in a kind of a sweet spot because margins have expanded dramatically. Costs are rising, but much more slowly. And I think the message from the market that they are hearing is that the market doesn't like huge capital builds. So I think that the bar in terms of return on capital, at least again, I'm talking about a sweet spot of a couple of years where the financial discipline will be exercised. So the sins of the past, I'm not saying forever, but at least for the time being, I think they are their history.
Great, thank you. Let's go back to you, Maria. This is based partly off what John had mentioned about gold versus gold equities. Are you seeing a similar disconnect between the price of silver relative to equities that predominantly mine silver?
Yes, absolutely. Silver equities up until very recently have underperformed the silver bullion. Yes, very similar picture.
Okay, thank you for that. We've got close to 70 questions coming. Each time I click on one, it keeps moving. I apologize for that. Okay, here's the next one. This goes back to the comment I guess you made, John, with regards to bonds. How can physical gold be considered a safer asset than bonds, given its much greater volatility than a 5-year or 10-year treasury? Any comments on that?
Sure. If you just look at the performance of gold versus bonds, it's been lights out in favor of gold. Again, to me, if you, the trade and it's just a trade. If there's a recession, I think bonds will do very well. But if you look at the fiscal aspects of the U.S. And the mismatch of supply and demand that I talked about in terms of foreign entities no longer less willing to cycle back into treasuries, it's not a very pretty picture. Gold, I think, just by demonstrating superior performance to bonds over the last 20 years, I think that makes the point. Is gold more volatile? I'm not so sure. I think the volatility in bonds, particularly in treasuries, has been quite high. I just really question whether bonds can maintain their status as the safe asset that they used to have.
Thank you. And let's stick with you for one moment on gold a little further. Maria, this is a question that said, Maria made comments about silver and its demand from renewable energy and sustainable energy. Are you seeing anything like that as it relates to gold, or does gold continue to be simply a monetary metal?
No, I think it's a monetary metal. I think any other argument really doesn't carry that much weight. So very different from silver.
Thank you, John. And Maria, let's go back to you. It seems like every time we have you on and there's there's silver comments, the gold to silver ratio always comes up. Investors like to talk about it. The question is, what are you seeing out there right now? Any signals that the gold to silver ratio is out of whack, or do you see it kind of humming along nicely? What should we be looking for going forward as it relates to the gold and silver ratio?
Well, yes, it's definitely out of whack. As I mentioned, since the 70s, the average gold to silver ratio has been about 59. So let's round that to 60. Well, it's now 83, and that's a recovery from 90. So it is still out of whack. Now, it could go to 40, and it has gone into 40 in the past. It does swing around quite a bit, but it is low right now, and I would definitely expect it to revert to at least an average, or the average. And that's why my prospects for silver are actually very bright, partly because of this kind of out of balance situation we have right now.
And Maria, what is the modern kind of average for gold silver ratio? Is it still in the 70 range, or has that changed a bit as well?
Well, it depends how far back you go. Since the 70s, it's 60. More recently, it's 70 from my math. And, it went as high as 120 in COVID times. So,
okay.
Yeah, we are below
silver
that.
Silver snapped back quite nicely when it was at 120, if I remember correctly.
Yeah, that precipitated. And it was very interesting because when it reached 120, people literally were throwing in the towel on silver. And I said, okay, well, no, this is the bottom for silver. And of course, post-COVID, it did bounce back nicely.
Great, thank you. And we've got a lot more questions than we could possibly answer right now. But again, we will be replying to everybody in the next couple of days. John, why don't we end with you? And this goes back to the basics of investing in gold and silver, I guess, to that extent. And the question is, as a newer investor to commodities, how should I think about the physical market versus the miners or the equities? could you give us some insight on that? And maybe this is a two-part answer. Maybe, John, you could talk about it a bit, and then Maria, maybe you talk about it. How should one think about the physical market, and how should one think about the equity or miners themselves? So let's start with you, John.
I have to do this in a minute. So gold is a safe asset. I think for people with low risk tolerance, the metal is the better place to be. If an investor is in agreement with the view that we're in a world of monetary debasement and wants to maximize exposure to that view, then gold stocks may make more sense, but there has to be an element of risk tolerance.
Mm-hmm. And anything to add to that then, Maria, as it relates to the silver allocation?
Well, yeah, I would say that, I would use silver and silver equities as a layer on to gold and gold equities. And let's remember that there is overlap in the equity space anyways, not in the bullion, obviously, but a lot of the equities have both gold and silver. So there is overlap, but I would use silver as a layer to gold.
That's a great point, by the way, the gold and silver overlap that many mines are producing both. So thanks for that. Well, we certainly appreciate everyone being on the webcast today. John and Maria, thank you very much for making the time to do this as well. And again, please reach out to us if you'd like to learn more about Sprott as a firm and the product suite we offer, whether you're looking at allocating to the physical market to offset some of that risk in your portfolio, or the equity market to participate in the opportunities we see coming our way, as John and Maria have mentioned. So once again, my name is Ed Coyne, and thank you for listening to today's webcast.
Great. Thank you so much to our speakers today for such an informative discussion. As a reminder, materials have been made available for download, can be found in the documents folder at the bottom of your screen. We appreciate your feedback. Please take a moment to fill out our brief survey, also located at the bottom of the console. If you'd like to have a conversation to further discuss the ideas that were covered during today's event, please click the blue confirm button in the media request box on your screen. Thank you so much for joining us, and enjoy the rest of your day.